Hi, I'm Tim Chubb, Chief Investment Officer here at Girard.
And I'm Tom Miller, Director of Investment Strategy here at Girard.
So we've talked some markets, let's talk some macro. Certainly the war in Iran really was the headliner for inflation, but we also had some decent growth backdrop too, right?
We did, and I think that's an important concept here. Inflation ran hot, primarily driven by the Iranian conflict and oil prices rising. What I'm looking forward to in the second half of the year is a reversal of that, hopefully. I think as a firm, we were hoping for disinflation in the second half of the year. It went the wrong way on us the first half, but I think that trend could continue again in the second half, barring anything unforeseen, and we absolutely need the conflict to be resolved.
Absolutely. Yeah, I mean, oil prices have increasingly become a smaller and smaller portion of the average American's, household budget. Many of us, working from home, demographics, all of that. At the end of the day, you can see how higher oil prices, higher fertilizer prices, they can start feeding in with freight shipping costs. And so certainly welcome news to see, oil back down to the pre-war levels. But overall, from an economy standpoint, really concentrated in the AI sector. And we're actually getting some inflation from memory, prices from that as well. So like you said, I think, as we started this year is expecting that we would continue to see that disinflation. A big piece of that was tariffs, kind of rolling off the books. But as we look in the back half, so long as the lower oil prices, I think stay in place, we could be talking about perhaps some rate cuts in early 2027.
Which would be nice, especially as the market started to reprice in hikes with the Iranian conflict. So I think as we sit today, we're about neutral, maybe one hike, but hopefully we start to talk about cuts next year. And that should hopefully help in the whole backdrop of propelling earnings growth across more sectors than just the AI sectors we've seen.
Yeah, absolutely. It's also a huge function of, sort of this K-shaped economy, this no hire, no fire, type of labor market. Kind of walk us through a little bit on really what we saw from consumer standpoint, coming into this quarter.
Yeah, it's funny. The consumer's been so resilient, which has been so good. But the question is, are we getting to the end point here? With oil prices coming back down, I think it's good that we should start to see the lower end consumer, if you will, get a little bit of a reprieve here.
Yep.
Because it has been a tale of two markets. Those that own assets are seeing appreciation. Those that don't are having a tough time right now. We're hopeful that we get to see this broadening out. Oil prices coming down. If we can get rates down because we have disinflation, that again should help all consumers, not just the higher end consumer that we've seen. So what I would say that's so interesting though, is we've never seen a market go like this with consumer sentiment being so poor.
Yeah.
And so this is like the bull market that, whatever cliche you want to use, everybody loves to hate this one. But in all reality, we haven't seen sentiment numbers like this with the economy and the market moving how it has.
Yeah, absolutely. It's been pretty remarkable to see. I think a lot of that has been just driven by some of the political preferences. We've seen this over multiple election cycles now, some of that discontent, but certainly higher prices have been challenging for the consumer for a number of years now. It's been 5 years since the Fed has been able to get back to its inflation target. We have a new Fed chair with Warsh, and it really seems like the goal is to get down to 2% still, but it just might be a 3% world for a little while longer here.
And since you brought it up, we definitely should pull more on that string of the new Fed chair and Mr. Warsh. And I think there were many that thought he would just come in and say, I want rates lower, because as there was almost a campaign for Fed chairs that we've lived for the last year and a half. But I think the market was a little bit taken back, but that is not the stance at all. And I think he's very serious about bringing inflation back to 2% and restoring credibility to the Fed. And so with all that being said, there's still some work to do, but the backdrop is pretty good. Any thoughts on what Kevin Warsh is likely to do here?
Yeah, well, it starts with the task forces. We've got 5 of those, and I think that'll buy some time to get their arms around really what the inflation backdrop will look like for the remainder of the year. Fortunately, the labor market's been hanging in there. And so as we think about the Fed's dual mandate, full labor market, we're at 4.2% unemployment rate, has been remarkably stable around that 4.2, 4.3 number throughout the beginning of this year. It's really just been inflation. And so, really it's trying to obviously, focus on not tightening of financial conditions too much to break the labor market and striking that balance, as Powell had remarkably done for a number of years there as well. So
yeah, and it was good to see the reaction of the markets after the first press conference of Kevin Warsh. He's obviously not going to communicate and be as transparent as previous Fed chairs, but the bond market took it pretty seriously as shorter term yields went higher, but longer term yields came down, which was good to see.
Yeah.
Right? Because the longer end of the curve is much more about inflation and growth, but has been so worried about inflation. And then with that press conference, to see that come back out and maybe some of those inflation expectations being removed from the market.
Yeah, it's been really one of the more comforting things, talking about the consumer surveys. One that I think, deserves credence has been just consumer inflation expectations. And so although sentiment has been pretty poor about the broader economy, we haven't seen those, consumer inflation expectations become unanchored. And, I know we've had client concerns about, is this 1970s all over again? That data point right there, I think really pushes back hard on that.
Yeah, it's exciting to see the markets react perhaps a little bit more in line with how we would expect than what we've seen the first half of this year. So looking forward to a calmer second half.
More
hopefully.
predictable. Yeah.